Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, August 3rd, 5:10 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in an uptrend that got a little bit stronger today. You check over here at the trend gauge. You can see we upgraded market leaders from neutral to bullish. This was based on a combination of the 2121 list acting well and also the G6 acting well above its 21 and 50-day moving average. So went ahead and upgraded that today. It joins our short-term and our medium-term indicators in bullish/uptrend mode, which means all five of the major indexes are trending above their short-term 21-day exponential moving average, also above their medium-term 50-day moving average, still under the long-term downtrending 200-day moving average, but inching closer as we continue to work our way higher. What just happened? Clean break above 3-day bull flag. In last night's video, I showed what has been a bearish setup, that being the US dollar, the 10-year note, their stochastics coming up off of oversold and crossing, coinciding with an overbought S&P 500. That could be interpreted as bearish, but that's a secondary indicator. Price and volume go first. So I asked in the headline, is it a bull flag or a beginning of a move lower? And the market responded emphatically with a clean break above this 3-day bull flag. Really 2 days of a pullback. We really started flagging the last half of the last day that we were higher, so it was almost a 3-day bull flag. Clean break above it. You got to pay attention to what the market's saying, regardless of what indicators or opinions might contradict that, including macro opinions also. But for right now, leaders acting well, and we're trending above the 21 and the 50-day moving average, and we continue to pile on gains. G6 up 1.8%. Maybe the G6 was indicating that we were going to go higher, as it was green the last 2 days, while it was green on Monday and Tuesday while the indices were red. So, and it participated today up 1.8%, S&P up 1.6, Nasdaq 100 led the way up 2.7, Dow up 1.3, mid caps up 0.85, Russell up 1.4, Global Diversified 60/40 stock and bond index up 0.92, GROTECTION, our in-house portfolio, up 1.07%. We added more exposure today. I'll talk about that as we dive in a little bit deeper. And let's start doing that dive now. Let's take a look at the S&P 500, and this kind of explains what we do at Revere Asset Management. You saw the trend gauge. We're trend followers. We follow the market according to 3 time frames and also separate what leadership is doing. When the market is trending higher, we participate. When the market starts going sideways, our stops will start getting hit. We'll start easing out of the market. We'll start locking in profits, and we'll pull back more toward a neutral position when we start rolling over and getting below these moving averages. The green is the 21 short term. The red is the 50-day medium term. The black, this is really our last line of defense. When you're under here, this is where the carnage happens. All historical big bear markets and severe bear markets start off with a weekly close below the 200-day moving average. This is when risk picks up. This is when we really back away from the market. And this is what we've done through most of 2022, particularly this period right here when we broke back below in early April and got out of the way of this big leg down and this move lower. But now we come off the bottom, we look for signs of strength. We've seen them in some leading stocks. Then we start getting back above the indexes and we start putting exposure on. And what we want to do is finance our gains and finance our exposure with the gains that we're making from these early moves into the market. If they start showing progress, we can move our stops up, add more exposure, and now we're to the point to where if all our stops got taken out, we wouldn't lose. We wouldn't go back below at our capital levels, below where we re-entered back here when we first got back above the 21-day moving average. So we're kind of, you could say we're free rolling right now. The big key would be if we break below this bottom of this little range that we broke out of today. That would mean that this is a false breakout. We would immediately get more defensive, because that would be the market. From failed moves come fast moves. That would be the market telling you that this little break higher, we weren't ready to go higher. It was false. And then if we broke back below these lows of that little 3-day consolidation there, that would be telling us that this may have been a fake out for the bulls. But for now, we put more exposure on today. It's going higher, and our accounts are making recovery highs off the bottom. So they're good signs. We don't say we're bullish or we're bearish. We interpret what the market is telling us, what the exposure that we put on is telling us, and just speaking facts, not opinions. So that's the S&P 500. That explains what we do on a trend following basis. And if you're interested in this approach, you can email me, don@revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. Let's bring up the tail of the tape now, dive a little bit deeper. Still, since we went to this bull case after the follow through on the Fed, ironically raising rates on 7/27, this is when we really started making progress. So news today, OPEC output, say that fast 3 times. OPEC output increase was less than expected, and pre-market oils were higher on that, but they reversed lower through the day. So this is opinion. Increased less than expected, oils should go higher. That's opinion, but this is fact. Oils reversed lower. Money has been coming out of oils and going into growth very clearly. So we did have some possibilities pre-market. We talked in our pre-market meeting about possibly putting some oil exposure on, but they reversed right off the open. So those didn't come to pass, and we just move on down the list to the things that are working. So I mentioned that note last night, TNX and UUP, the US dollar daily oversold stochastic cross was bearish recently. But that very clearly, the market ignored that today, and as a result, with that breakout of the bull flag, we put the more exposure on. So my expectations coming into today were, after a tight 2 days, really 2+ days, a directional move. I didn't know if the direction would be up or down, but very clearly it was up, and I'm not going to argue with the market. So strong move up, expectation exceeded, you could say, for the directional move, because it was higher. So we have our support and resistance areas. We move up through support and resistance is 41.20 with strength, 41.78 now. That's the top of this little shelf here from back in June when we consolidated with that last attempted move off the lows. That's the next area of resistance. We've already passed this shelf on the Nasdaq 100, by the way, which is showing extreme strength, and that's where we focused our buys today. So, and here's the Nasdaq. This was that fib and that support resistance level. That's a 100-day moving average. That also coincided with this little bull flag, natural area to pause. Strong move up off there, and then through the resistance, this 318 level. So continued moves through resistance indicate a bullish market. Let's see what else here. Sectors that were strong today. I mentioned the UUP setup. Even though we continued up on the dollar, although it faded as the day went on, the market ignored that today. Biotech, which I got stopped out of on a close below the 21, making a fool out of me, as we had a big move up in ALNY. I'm going to show that before I finished showing the indexes, but ALNY drug phase 3 results, we're still diving into this, up 50% on almost 1,000% volume. You got to look at this when that happens. We've got our alert set below the low of the day. We had one intraday after this move off the high, but we got to do a little bit of research on this. And this lit a fire under the biotech sector. Here's XBI. Here's the close below the 21 where I stopped out. Moved above the 21 yesterday and a gap up today, closing mid-range. Still facing some resistance here from this failed move attempt out on 720. So it hasn't gotten away. We're still below that area. So this is something we're taking a closer look at now, biotech, as it seems to have rested for a while. So let's finish the rest of the indexes very quickly. Here's the Nasdaq 100. There's the break above the bull flag up off the 100-day moving average. That's the purple line. Giving you everything that you could possibly ask for if you're a bull. Here's this 314.56 area. Really, this consolidation was at the top of this, so we're further up, and that's indicated by this blue line, this blue relative strength line on the Nasdaq 100 has been outperforming. You know the Nasdaq 100, we historically talk about it all the time. It lags on the way down, or I should say leads lower relative to the S&P 500, and then it leads on the way up also. Let's go to the Dow Jones Industrial Average. This is one that usually lags on the way up as it's doing, but it leads on the way down on a relative basis, as you can see here on the relative strength line. It's looking fine. You just don't want to be focused on the Dow when the Nasdaq 100 is very clearly leading. As you can see, this did not make a higher high out of this area here, this 3-day bull flag, and the relative strength on this move up has been lagging. MDY mid caps still in this little consolidation above the 100-day moving average. Really just going sideways with the market, lagged a little bit today. IWM, let's take a look at this. This is the small caps. This did break out. Actually broke out yesterday, but then pulled back into it, made a higher high today. Still not above this 190.94 area. That was the high of this consolidation here as we were waiting for the prior CPI report. So a little stronger than the S&P 500, but weaker than the Nasdaq 100 relative to that area back in the beginning of June when we put in that consolidation area. So let's get back to the tail of the tape here. Let's see what else. Software strong today. IGV up 3%. Net, NET, up double digits. This is trying to put in a bottoming base here. They've got earnings tomorrow. We'll be keeping an eye on that. 10% move up off of this 21 and 50-day moving average that have tightened this 50 level. Very clearly strong support for Net, and they are going to start making money, although their PE is outrageous. Let's see what else. XLC, KNY, those are really the tech/growth sectors within the S&P 500. They acted well. Bonds started out weak, but reversed strong intraday. Let's take a look at a 5-minute on the TLT. So you can see we started out higher yesterday and then faded badly. We started out weak this morning and then got strong as the day went along. I don't know what was going on here. I think there was a bond auction or something like that, but that put in a bottom. Let's see where that is. Let's break the chart back a little bit so you can see kind of a lot of support here on the TLT right around this 116, 117 area. So all we did is undercut and move higher off that today. So basically you could call that a failed breakdown on TLT, and then we went higher. Let's look at it on the daily for where we are. There below the 100-day moving average. If we get above 120 here, that's kind of a pretty big battleground area going back to April to May. Let me reset my alert here so that we'll know when that goes off. So that's what bonds did. On the other hand, I mentioned oil started off strong and got weak. Solar, mixed bag here, pretty big story. Sedge, there's two big inverter companies, Sedge and Enphase. Enphase we know is a very clear leader. Sedge was riding the coattails of Enphase with this move, but really disappointed, missed on just about every metric on its earnings report, down 19% on 500% average volume. Still above the 200 and the 50-day moving average. That's how far extended above it was. But if I were a portfolio manager, and I am, and I own Sedge, I would be selling Sedge and putting it into the inverter leader, which is end phase, and that's what we did today. Now, we missed this initial move out, so we were still being defensive, waiting for the Fed last week. But sometimes when you're extended, you got to go down to lower time frames to look for a decent entry. We used the intraday stochastics to do that today. We're able to get in at around 282 and then add a little bit more at 285. We're going to let it settle for a little bit, and because we want the moving averages to catch up to this consolidation that's going on here. So we were able to get a small position in probably the leading stock that's out there right now, end phase. So here, portfolio changes. Well, of course, if you're in a hole, you want to stop digging. It's okay to be wrong. It's not okay to stay wrong. I say it all the time. So when the Qs broke above, I took off my hedge that I put on yesterday when we broke below the 100-day moving average. 2% loss on a 5% position, impact to the portfolio 0.1%, a paper cut. I'm fine with that. Silvergate, we added to our Silvergate position as it showed some strength today, but then it faded toward the end of the day. So when it broke above this 95 area, we doubled up from 2% to 4%. This is an extremely volatile stock from an ATR perspective. Don't want to get it sized up too much, but we ran into this Livermore area, the Jesse Livermore 100 area, twice, tried to get through it, failed, and then pulled back later in the day. Still very clearly a leading stock with the very strong volume pattern since its last earnings report, but no question 100 is going to be some resistance there. So we added to Silvergate. We got rid of PSQ. I talked about how we tiptoed into end phase, and then I mentioned earlier in a video within the last, after this gap up, we were monitoring Amazon and Apple for how they were reacting after their earnings gaps. 2 tight days inside the initial earnings gap, not giving any of it up, and then a breakout above it today, very similar to the breakout that the Nasdaq 100 did. And we put on a 4% position size in Amazon and a 4% position size in Apple. Same situation. Nice little flag. Here's the earnings. Here's the pullback. Holds the 200-day moving average. Note the volume lighter. These are perfect volume patterns. Take a picture of this. 3-day pullback after a move up. Look how light the volume is on the pullback. 3-day move up on average to above average volume. Remember, Apple is a very big stock. In fact, it's the biggest. 2-day pullback below average volume, blows through this little consolidation here. It was above average volume early in the day, faded a little bit through the day, but relative strength at a new high, you got to own it. So we took a 4% position in Apple today, and like I said, this coincided with the QQQ. And the good thing about this is that if these fail or break down, we've got very easy stop points on this because they should not break below the low of the gap up day for either Amazon, Apple shown here, or Amazon. Apple, that coincides with the 200-day moving average. For Amazon, it's just a couple percent lower. The low here, 132, we're at 139. So very easy stop out. So, and if that fails, if those two fail, you're going to see this Nasdaq 100 breakout fail also. So very low risk entry points. We can easily flip this exposure that we put on and either break even or just get nicked for very small losses. So bottom line of today, strong break above the 3-day bull flag. We added exposure. Our adjusted beta is now just about 1, which is about the same risk as the S&P 500. We're at 0.98%. Still got plenty of cash available, and that's one of the reasons why we use SSO the way we do, to get the exposure with only half of the capital being used for the exposure that you get. So take a look here where we are on these key levels. Up above here, 2 big levels. The top of the range, that 4178 level, which is that consolidation back in early June, and then above there, a big fib, 23.6% retrace off the top of the COVID rally at 41.99. So this 41.80 to 41 to 4,200 is going to be a big area that we're coming into. Might be time for another pause. Remember, markets can only do three things, and they coincide with what we show here in the trend gauge. They can either trend up, be neutral, or consolidate, or trend lower. Those are the only three things that they can do. Identify what they're doing, and they do it across multiple time frames. This is just a very short time frame. This was a 3-day time frame. On a 60-minute chart, or a 30-minute chart, or a 15-minute chart, you can see we're just consolidating, consolidating, consolidating. Boom, break above. So, I mean, the market's fractal. These patterns happen across many multiple time frames. But so added exposure, we've got our break, we've got our stops in place, and we'll see what happens the next day. Usually, I mean, we had a nice 3-day trend up here, 2-day consolidation. Higher or another time for consolidation. We are a bit extended from the 21-day and the 50-day moving average, but a lot of the reason for that is because the slope of the lines have just changed and you can get extended from there. It's not the same as being extended 6% when you've been in a long uptrend above the 21. It's very different when the slope of the lines recently changed. So what other tickers do we want to look at? How about some earnings reactions? A, B, and B. Gap down this morning, 10%, closed at the top of this range. Sometimes negative gaps down are bought. That gets rid of all of the sellers, and we work our way higher, and that's what happened with Airbnb today. PayPal had a gap up, but ran into the Livermore 100 resistance area, got above it, couldn't stay above it. Also, a big battleground area over here from February, March, and April. I'm going to set my alert for this to see if it gets back above 100. PayPal was an hedge fund and institutional favorite for a long time before giving up in a major way. I already showed Sedge and that gap down Generac. I've been keeping my eye on this one. I liked it. Their numbers were a beat. It's very reasonably priced, and it gapped up and promptly rolled over and sold off hard on double average volume. Did hold the 21-day exponential moving average, but that is not the reaction that you want to see to earnings. Let's see what else I want to point out here. I think that's it for today. So that's going to wrap it. As always, love to hear feedback from you. You can email me, don@revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. So wrapping up Wednesday, August 3rd, this is Don Vandenbord telling it like it is. Thanks for listening and have a great day.